Hello everybody, my name is Lush Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record a video per week, so make sure you ring the notification bell to get notified each time one comes out. I will continue a new thing I'm trying for 2025 for the new year. If you comment in this or the other videos that come out in February, I will put you in a draw for a 1-hour one-on-one mentoring video call with me, a $50 value. We can look at your portfolio, talk about financial independence, personal finance, retirement, whatever you'd like. So comment below. Up to 4 entries are allowed, 1 per February video. Now, there was a Morningstar 2024 research which suggested that 3.7% is the highest safe starting withdrawal rate for retirees spending from an investment portfolio, wanting the 90% success rate of the money lasting over 30 years. To summarize that research, while fixed real withdrawals offer the benefit of simplicity, dynamic strategies factor in portfolio performance and spending. To determine the right withdrawal strategy for you, it's important for you to consider market conditions, inflation, and your lifestyle habits. Investors seeking the highest level of lifetime income should consider a combination of delayed old age security and CPP filing and a flexible withdrawal strategy such as the guardrails approach. Retirement income sources play a major role in an investor's retirement plan. But to get to the topic of this video, what is the best retirement withdrawal strategy? Even though investors have different priorities, one major goal is to have enough retirement income to support their lifestyle. Here are some common strategies to consider. So there are the fixed real withdrawals. This system offers the benefit of simplicity and most closely approximate the consistent paychecks that people grow accustomed to during their working years. More specifically, it involves setting the starting withdrawal amount and then taking inflation adjustments to the dollar amount each year thereafter. While taking a fixed percentage withdrawal solves the problem of running out of money, it does so at the expense of the retiree standard of living being possibly impacted by changes in the value of their portfolio. Next is dynamic withdrawals. Even though every retirement strategy has trade-offs, dynamic withdrawals offer flexibility for retirees through market fluctuations. These strategies change withdrawal amounts from year to year, taking lower withdrawals in weak market environments and higher paydays in strong ones, typically allowing for higher starting and lifetime withdrawal rates. The approach may help retirees consume their portfolios more efficiently, factoring in both portfolio performance and spending, but they also add variability to cash flows. So let's look at 4 dynamic withdrawal strategies. To help identify how these strategies balance lifetime income with consideration of quality of life and the volatility of cash flows, I'll break down some of the most widely used approaches. Number 1, foregoing inflation adjustments following annual portfolio loss. This conservative method begins with the base case of fixed real withdrawals through a 30-year time horizon. However, to preserve assets following down markets, the retiree skips the inflation adjustment for the year following a year in which the portfolio has declined in value. For example, an investor wouldn't increase portfolio withdrawals after the 2022 bear market despite the large jump in inflation during the year. This might seem like a modest step, but the cuts in real spending are cumulative and can permanently reduce the retiree's spending pattern. Second dynamic withdrawal strategy is the required minimum distribution, RMD. In its simplest form, the RMD method is a portfolio value divided by life expectancy, and it's designed to ensure that a retiree will never deplete the portfolio because the withdrawal amount is always a percentage of the remaining balance. The age for RMDs is now 71. And because money doesn't stay in the RRSP forever, RMDs will be taken from those plans. Even though considered safe, an RMD system incorporates 2 key variables for retirement spending plans: remaining life expectancy and remaining portfolio value. While changes in life expectancy are gradual, the fact that the remaining portfolio value can change significantly from year to year adds substantial volatility to cash flows. Number 3, guardrails. The guardrails method sets an initial withdrawal percentage, then adjusts the subsequent withdrawals annually based on portfolio performance and the previous withdrawal percentage. That means it attempts to deliver sufficient but not overly high raises in upward trending markets while adjusting downwards after market losses. In upward trending markets where the portfolio performs well and the new withdrawal percentage, adjusted for inflation, falls below 20% of its initial level, the withdrawal increases by the inflation adjustment plus another 10%. The guardrails apply during down markets too. Specifically, the retiree cuts spending by 10% if the new withdrawal rate adjusted for inflation is 20% above its initial level. This method acknowledges the fact that weak returns are dangerous early in retirement, but less so later on. And finally, spending declines in line with real-world spending data. Morningstar also tested a strategy that incorporates the average decline in spending that occurs over the retirement life cycle. In last year's study, Morningstar incorporated research from the Employee Benefits Research Institute demonstrating that inflation-adjusted household spending has historically fallen by 19% from age 65 to 75, 34% from 65 to 85, and 52% from age 65 to 95. Morningstar then adjusted the annual spending numbers to match up, assuming that real retirement spending declined by 1.9 percentage points per year between ages 65 and 75, 1.5 percentage points per year between 75 and 85, and 1.8 percentage points per year between 85 and 95. This year, Morningstar streamlined these assumptions to reflect a steady decline in inflation-adjusted household spending of 2% per year throughout retirement. So how do I determine the right withdrawal strategy? Although there are unknown factors in retirement, such as when people may retire and their life expectancy, it's possible for you to make informed decisions. Take a deeper dive into these considerations. Number 1, market conditions. The right withdrawal strategy and rate really depends on the time period and confluence of market events in play during that drawdown period. Still, it's extremely tough to predict market conditions over a specific drawdown period. Let's take your portfolio encountering a bad sequence of returns, the danger arising from withdrawing assets from a shrinking portfolio, or poor market conditions early on in retirement. In those situations, investors should be conservative about their starting withdrawal. Despite not knowing what market conditions will prevail over our specific retirement time horizon, there's benefit to checking as investors begin retirement planning. Next is inflation. Another issue that is that inflation builds upon itself, and that's a negative for your portfolio. For example, if there's a 10% inflation rate in the first year of retirement that returns to normal, every future year of spending has been impacted by that first year inflation rate. Plus, older adults tend to spend more on healthcare. While Americans 65 and older make up less than 20% of the population today, they account for over a third of total drug expenditures. Obviously, in Canada, we have plans to offset that, and medical is generally free. But when looking back on historical inflation, we know that healthcare inflation historically runs higher than general inflation rate, making it an additional risk for both Americans and Canadians. In comparison to people who work, retirees don't get those cost of living adjustments automatically in their paychecks, proving the importance of building a portfolio that's protected against cost of living increases and inflation. And finally, lifestyle. Spending tends to start higher, often coinciding with people's good health years, and declines in the middle to late retirement years before elevating later due to healthcare and long-term care factors for Canadians. This is the so-called retirement smile. The way that investors decide to spend their money varies based on their needs and wants. Communicate with your partner and family as to your goals. This is an important step, and it may also allow you insight into how you can use various investing tools, such as cryptocurrency and online trading platforms, to reach your goals. So to summarize, while fixed real withdrawals offer the benefit of simplicity, dynamic strategies factor in portfolio performance and spending and are the better choice for how to spend your money. Just find the best dynamic strategy for you. Let me know in the comments if there's other factors that play into your withdrawal strategy and what withdrawal strategy you use, and to enter the draw for the one-on-one hour of mentoring for February. If you have any requests on what you would like me to cover in future videos, please put that in the comment section. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.